what we advise people to do is evaluate very carefully why you are adding space, so that we as a company helping you could figure out which builder, which way of construction, which type of a structure will answer those needs best. And I'm showing this picture so that you understand that it's not just about all the housing, it's also how you plan the new construction. We always think about this in advance, so that when you build new home, for example, you're thinking that, well, if I need to add additional unit later on, my sewage system, my utilities have to be ready for it. And then there is another very interesting trend happening in real estate, which is co-living. We see a lot of people looking at their own single-family residence and thinking, can we make it into some sort of collaborative housing, so that it becomes a compound where several families can live, and it's definitely a way for the multi-generation family to live. So the next step after you figure out the wish list, as I call it, is feasibility. And that's where most of the research comes in. And you do it either with your own planning department, you can do it with a builder or a consultant or future project manager, or you can also check with one of the startups in the space. It's called Symbiom. They are gradually adding on more cities, so that you could put in your address and then they'll give you the outline of what's possible on your lot. And actually, I need to put that in the chat later on. Part of the step of the feasibility is looking at the site and evaluating like what is possible. Are there any restrictions that make some of the construction methods, for example, impossible? Or maybe there are other things that might come out later in estimates that you have to take account of. And then we come to the financing, and Sahil, I think you should prepare yourself, because I'll ask, like, where in this chart, where do you come in? Because I've heard from builders a lot of times that they spend a lot of time with their homeowners, prospective clients, and like dreaming about the house, drawing plans. And then when they're almost ready with the plans, the homeowner goes like, oh, now I'm going away to figure out financing. This is not how it should be done. Feasibility, financing, building. That's the way to do it. But also, and I'm sure that Sahil will agree with me, that there is no single answer to financing. Like, we cannot tell you like, this is the way for you to go, because it's always the mixture of different pieces of data that go in it, and there's everything is flexible, and also everything is possible these days. You just have to know where to look. And we also have a couple of companies just to kind of figure out what the landscape is on the www.detached.edu page. And finally, when you get to the design build, and this is where my personal expertise comes in, we can help you figure out which exact building or construction method suits your personal preferences best.
Well, everyone, it's really nice to meet you. You know, we've gotten a chance to kind of talk with Ulizia a couple of times in the past couple of months, and always been a pleasure. I think the amount of thought that she's put into, I think, ADUs in general as a category, but more importantly, I think the impact that ADUs can have on homeowners and housing in general is a big thing that we at NOAA also believe in. And what I wanted to talk with everyone today is, as she mentioned, that financing is such a critical component, right? You know, we at NOAA believe that, I think, access to capital, access to credit is essentially a fundamental human right. But it's more so important for homeowners, especially when they are embarking on home renovations, on ADUs and other things. And what we've done is we've developed a new way, an innovative way for people to finance their homes without taking on the burden of debt, without taking on the burden of monthly payments, because we recognize how challenging that is for existing homeowners. I'll start a little bit about the company and myself, right? So my name is Sahil Gupta. I'm founder and CEO at Noah. We are a company that has been around for 4.5 years now. We were previously called as Patch Homes, and we recently rebranded to Noah, in March of this year. And we are a venture-backed, company. So we have some very well-known investors like Union Square Ventures, the co-founders of Airbnb, the co-founders of Clutter, and a bunch of other VCs and angels have invested in the company. And before starting Noah, I have a background in financial services and consumer finance. I have worked at Fortune 100 companies like BNY Mellon, and I've also worked at startups that were backed by big banks like Goldman Sachs and JP Morgan as well. Our mission at Noah, right? So this is, I mentioned how we believe that access to capital, access to credit is a fundamental human right. We recognize that in today's world, a lot of you have a ton of home equity, right? Because you live in California, you live in other parts of the country, New York, Chicago, wherever. And over the past 5 to 10 years, you have seen the values of your home go up. But at the same time, I think the economy hasn't been the greatest, right? Especially income and wages are mostly flat, outside of a certain sectors. So what ends up happening is a lot of homeowners today in this country are asset rich because they have tens of thousands, if not hundreds of thousands of home equity, but they're also very cash flow sensitive because after paying down the mortgage and bills and student loans, they don't have a lot remaining for, say, ADU construction or anything else. And that is why it's our mission to help homeowners, unlock the value of homeownership, help you access a lot of your hard-earned equity as well. And the way we do that is through the Noah Home Value Investment, right? So today we are available in 11 different states. I have them listed on the slides here. We cover about 55% of the US real estate market across California, Washington, DC, New York, and Colorado, Oregon, Virginia. We cover more than half the country. We have funded more than $200 million of homes in the past 2 years alone. So, I like to say that we work with all types of homeowners, people who have single family homes, people who live in, say, condos or apartment buildings, people who have townhomes. We have worked with investment properties, with rental properties, you name it, and we funded it. And the way we do that is very simple, right? A Noah Home Value Investment allows you as a homeowner to access as little as $30,000 to as much as $350,000 of your home equity without a monthly payment, without any interest rate. Now, the most obvious question is, Sahil, how are you doing this, right? How are you giving me money without charging me anything in return? But the reality is, it's called a home value investment, in that when we give you money, we are essentially making an investment in you and your home. And over time, our expectation is as the value of the home changes, if it goes up or if it goes down, the value of our investment will also change. So think of Noah as a partner to you in the journey of home ownership rather than a traditional lender. Now, before I dig in more into what Noah does as a company, right, I also want to talk about that for you as a homeowner. So what are the options today when you're looking for ADU construction and ADU financing, right? So when we did our own market research, when we spoke to hundreds and hundreds of homeowners, the first couple of options that come to their mind is, I can take a personal loan. So a lot of homeowners, especially those who are building either smaller ADUs or need a small amount of capital, say 5, 10, 15,000, they often go with a personal loan because it's easy to access and they can get the money in a couple of days. I think that's great, but it is a very limiting factor because the amount of capital you can get is really low. And credit cards are the same thing. I think, say, most of us have credit limits of a couple of $1,000s. That's not enough to build an ADU. And Olysia will talk about it, right? Where it can cost $50,000 to $100,000 to maybe $200,000, depending on the size of the lot and what you want to build. And which is why the third option that a lot of homeowners think about is home equity loans. So they will go to JP Morgan, they will go to Wells Fargo, they will go to Bank of America and say, hey, I have a mortgage with you, I'd love to get a home equity loan. But to much of your surprise, what happens is most of the big banks today are not really doing home equity loans. In fact, I think because of COVID, we saw every single of the big bank has pulled back from home equity. And even if you did get one, the simple thing across all of these solutions is these are all debt, which means you can expect an interest rate anywhere from 3 to 23% based on what you choose. You have a 50% or less probability of getting approved for it. And even if you do get approved, even if you are willing to take a high interest solution, you will have a large monthly payment. And the reality is that a lot of us are cash flow sensitive. So where do you get that extra $1,000, $2,000 of a monthly payment as compared to building the ADU that you wanted to do? I'm not saying that these solutions don't work. I think they work if you can qualify, if you're okay with paying 15, 18% interest rate, if you have extra free cash flow where you can afford the $1,500, $2,000 payment, absolutely, these solutions make sense if you're not cash flow sensitive. But if you are part of 80% of America that is asset rich and cash flow sensitive, then this does not make sense for you today. And that is the reason we launched NOAH 4.5 years ago in 2016. We said there has to be a better way for people who spend the last 15, 20 years of their life building a home, building a family, being a homeowner, paying their bills on time, but like for some reason are cash flow sensitive today, right? The NOAH home value investment is, first and foremost, it's not debt. It is not a loan. We don't report to the credit bureaus. It does not show up on your credit report at all. It is actually a real estate investment that we are making in your home. We invest in your home upfront, and the term of every transaction with NOAH is 10 years. So which means that for the next 10 years, you do not have to worry about a monthly payment. There is no payment of any type. There is no interest, there is no principal payment, and nothing at all for 10 years. So essentially, you get access to capital without having to worry about paying us back. In exchange, we are now becoming a partner. I said at the start, right, this is a partnership-based financing model. We are now becoming a partner who will share in the ups and downs of the future value. So if your home goes up, we will get a small portion of the gains. If the home goes down, we will also share in the same portion of the losses as well. So it's almost like we are a passive partner to you. You are the homeowner, you are in the driving seat, we are in the back seat. We are here to help you with money. We are here to help you with a lot of other things, but you are in charge. I also want to mention here, we get this question many times, is that does NOAH go on title? No, we don't go on title. We are not an owner. We have no ownership rights. We have no rights on the house. We simply have a lien against the property based on the investment that we make in your home as well. I want to stop here in case there is any question on the NOAH investment model, how it works and what it does, before I proceed.
I'm not sure what you're planning to show afterwards, so I'm not sure if this is a good time to ask, but if you are showing it afterwards, you can tell me. But yeah, what I'm thinking of is that there is a lot of companies who are doing a kind of basically taking your home, putting it into an LLC and doing some sort of a equity share, whatever program. And then it does go on the title, and then there is a lot of other issues that come up.
We don't do that. We don't do that at all, Olivia. So I think a lot of those companies like, maybe Easy Knock or Realty Shares or some of these other kind of, commercial real estate companies that came in the past, they essentially are buying your house from you. They're taking away title, and then they're putting it into these LLC structures and stuff like that. We don't do any of that. Your house, in fact, we have worked with homeowners where they own the house, husband and wife, or the house is in a trust, or any of these, similar situations. The ownership of the house, the title of the house does not change with NOAH. You remain on title, you remain the owner. We are simply a passive minority partner that is investing, and very similar to a mortgage company that puts a deed of trust or that puts a lien against the property, we become a junior lien. So in most cases, NOAH is a second lien, and in some cases a third lien on the house as well. But there is no change to the home ownership. There is no change to your mortgage. There is no impact on your credit score as well because we are not debt, and you get access to capital. Another interesting point is there is no tax consequence to you. So let's say, for example, you get $350,000. If you were to sell your house and get the money, that would be taxable. But with Noah, when we invest in your home upfront, there is no taxation on that $350,000 upfront as well.
So it's almost like it's very similar. You're creating a space that cannot be filled because the mortgage industry has become more restrictive. And again, like you said, we're very asset rich, cash poor, just to, to make it short, surmise. And you've created a product, it sounds like to me, I was a mortgage banker way back when, that actually takes care of a problem. You've created a solution for being able to go forward, and you have the lien on the house. So it's a lien on a home, which is a real, it's a thing.
Yes.
So that's your safety net, and yet the homeowner has some flexibility, which I'm excited to hear more about and hear about the terms of that flexibility.
Absolutely, right? So if who does it work for, right? So one of the things that with Noah, obviously today we are here to talk about ADU financing, and we've seen on our platform about 20-25% of the homeowners who come to Noah are often using the money either for ADU construction, home renovation, or home repairs. But at the end of the day, it's your home, it's your money, and you control what you do with the money, right? So even let's say, for example, you take $100,000 from us, and you decide to put $80,000 of that in an ADU, and the remaining, say, $20,000 for debt payoff in your bank account, we're not going to say anything, right? Because we recognize we've given you the $100,000 as a trusted home advisor, as a trusted partner. We don't dictate the use of funding. It's your money, it's your home, it's your choice. And what we have seen most of the times is a lot of people are using it for cash flow. A lot of our customers, I would say 30 to 40% of our customers are using Noah to pay off credit card, right? Because we discussed earlier, credit cards are at 24% APR. Your student loans are expensive. So medical debt is, the penalty on medical debt just keeps on rising and rising. So people use kind of Noah financing to pay off those debts because they don't have an offsetting monthly payment. In many cases, we've also seen people where extremely difficult for first-time entrepreneurs, for small business owners to get small business funding, right? You can't get an SBA loan in this country, I think. And the PPP loan, it showed us both the good and the bad of what happens when you apply for a government loan. People are taking Noah financing and using it to start their own small business as well. So the use case of the product and the capital is immense, but it obviously adds a tremendous amount of value for you as a homeowner if you build an ADU, because you can get rental income. You can increase the value of the house by essentially taking somebody else's money. And if the value of the home goes up, you are sharing a cut of the profits with us because we are a partner. If the value of the home goes down, you're also sharing a cut of the losses with the partner. So we are, one of the only companies that is sharing both the upside and the downside of the home value with you equally. And one of the things, Amy, I really like, what you said, right? That you've been a mortgage banker. So, who does Noah work for, right? What's the criteria of underwriting, if you may? And one of the things I'm very proud of saying is that unlike a bank or a lender, where it's almost impossible to know what the underwriting criteria is sometimes, we actually believe in complete transparency and honesty as a company, as a brand. You can go to our website, noah.co, and noah.co/eligibility, we open source our eligibility guidelines. Every month, every quarter, we update our website for the guidelines. If it's there and you qualify based on that criteria, you can get Noah financing. And generally, what we want is, as I said, we cover 55% of the country today. So we want to make sure that you are a homeowner in one of those 11 states. You have at least 20 to 25% equity in your home. As long as your FICO score is above 600, we can work with you. Now, this is a very big difference between us and a HELOC, a mortgage, a credit card, a personal loan, because they require you to have amazing credit. The reality is, who in this country has an amazing house, amazing credit, a lot of free cash flow, and no debt, and needs an EDU. That's the 1% of this country. That's not everybody on this call. That's not the 99% of this country that exists, which is why for us, our partnership is with you and your home. It's not with your credit report. So we have some minimum standards, but as long as your FICO is above 600, we are able to finance you. And also, most importantly, we recognize that you are in a situation that is cash flow sensitive, which means your debt to income ratio will be high. And that is the reason for the NOAH financing. Even if your debt to ratio is as high as 60%, you can still qualify. And for reference, I think most banks are in the 35 to 45 range at best, but it becomes really difficult for homeowners, especially existing homeowners, to qualify with those criteria. So we have made sure that our underwriting criteria is very expansive, so that more and more people can qualify, and we are able to assist them with the capital they need to do exactly what they need, which in this case would be kind of EDU financing as well.
May I ask a question?
Yes.
Like, I'm not a mortgage banker. I'm just your average homeowner as they come, plus I'm an immigrant. So bear with me. What do you mean when you say debt to income ratio?
Sure. So when I say debt to income ratio is if you look at all the monthly debt payments that you make. So if it's a mortgage, student loan, personal loan, the minimum payment on your credit card or anything else, if you take all of that and if you divide that by the gross household income, that is what a debt to income ratio is, right? A lot of banks, a lot of traditional lenders will use debt to income as a way to see, do you have the ability to service a new payment? And that is the reason they want your debt to income ratio to be about 30 to 35%, especially when you buy a house. But the reality is, the moment you buy a house, your DTI is beyond 35%.
What that means, just to clarify, is they want you to have a certain amount of cash that you can put toward, a certain amount of cash against the money, your expenses versus your income. So, this is so interesting because about 10 years ago, maybe a little more, it became very conservative and it was really, really difficult to get any type of financing like this. After the mortgage, debacle and the economy blew up.
Yep.
So basically what it is like, say, why don't you use 100,000 just to have a nice round number and give a scenario?
Absolutely. So that's actually, one of my next slides here, right? So before I go into a scenario, I just want to talk about how easy we've made it from a technology and a process perspective, right? So one of the things that always has bothered me is that I can get a personal loan in 2 minutes, but it takes me, 90 days to refinance my house. It takes me 68 days on average to get a home equity loan. It should not be that hard. And my dream, I have part of my team on the call and they'll ping me afterwards, but my dream is you should be able to refinance your mortgage with a click of a button. It should be a one-click process for you. And as we build a technology towards that, we today hold ourselves to a very high standard of saying in as little as 15 days, you should be in and out of a NOAH financing process. We have funded homeowners in as little as 10 days as well, where they come to the website and on the 10th day of the month, they have the money and they're off. Because you should be living your life, you should be focused on homeownership and not dealing with banks and lenders all day or up. So what we've done there is we built a qualification process. So if you go to noah.co, you click a button that says get estimate. In 60 seconds, we'll give you an answer to say, yes, we can fund you for $350,000. And here are the terms of that financing as well. If you like those terms and you say, great, I want to move forward, you complete an application, takes you only about 30 minutes online to complete the application. And in the next couple of days, we do an appraisal, we work with title companies all in the background. And then on the 15th day, we make sure that the money is deposited in your bank account. So start to end, our promise is 15 days or less. We do the work. We talk to every single company. We keep you updated through text messages, emails, and calls. You focus on your life and let us be a good partner to you on the homeownership side of things as well. Amy, you mentioned, let's talk about an example, right? How is it that this thing works? So I'll actually start with, a real life example of ours. So this is a customer of ours. His name is Gary. We worked with Gary in the first half of this year, and both husband and wife, Gary and, Janet, they found themselves in a situation that many of us find ourselves in, right? They have a ton of home equity, but because of certain financial decisions or personal situation, the bills and debt is piling up. Gary actually took $80,000 from Noah, and he actually did three things with it. He paid off a bunch of high interest debt. So he had some credit cards, he had some personal loans at 18% APR and 22% APR. He paid off those loans. And what happened is, because on his credit report, his loans went away, but there was no other payment from Noah because we are not a lender, his FICO score actually went up within a month. So Gary's FICO score went up by 30 points. So this is truly the impact of financial innovation, how real estate investment can help your personal finances. He also took a big chunk of the money. In fact, most of the money, they wanted to finish their home, right? Because what they did is what most of us do, what most homeowners do is they say, I'm going to take a personal loan, I'm going to take a credit card, and I'm going to start building this ADU. Because the contractor has said it's only going to cost $50,000. But 2 months in, that 50 becomes 75, and 2 months becomes 4 months. You are now maxed out on your credit card, maxed out on your personal loan. What do? And Gary found himself in the exact same situation. So he said, I'm going to take 50,000 and I'm going to finish my home renovation and the expansion of the house. And then he had a couple of thousand left, which he said, I'm cash flow sensitive. So the best thing for me is to keep that in an emergency fund to essentially supplement my passive income. So as you can see here, right, because Gary and and Janet are in control, they decided a bulk of the money for the ADU expansion, a little bit for debt payoff, and a little bit for savings, so that they can improve their overall life and their financial profile as well. And I personally, right, I remember talking to Gary on the phone one day, and he was like, I love the fact that I can access essentially my own wealth, my own home equity, and I don't mind sharing it with you because it was so easy, it didn't require an effort, and you're a partner to us. The underlying thesis, the underlying promise of Noah is we are a partner, we will be with you in good times and bad, and our first product, this home equity, this home value investment is just the first of many things you can expect from us in our partnership. So let's talk about an example here, right? So Amy, I'm going to use that 100,000 example, because everybody loves round numbers.
Yep.
So I'm going to assume that, let's say you have a home that's worth $1 million today. I think in California, it's okay to say that a home is worth $1 million. And you are looking to build an ADU, or you're looking for capital for $100,000 today, essentially. So when you come to Noah, you access $100,000, we give you $100,000, and in exchange, Noah now has a 13% investment in your home. So in exchange for the $100,000, we now have a 13% share, as we call it, as the Noah share for your property. And our promise to you is over the next 10 years, you don't have to make a monthly payment. You don't have to worry about interest rates. You don't have to worry about paying us back. So in the next 10 years, the opportunity for you is boundless, right? If you are building the ADU because you want to live in that home with your grandpa, grandma, or your grandkid, great, fantastic, right? So you benefit from ADU because you enjoy kind of living in there. I know many of us are looking to build an ADU, for rental income. So if you spend $100,000, you can potentially build an ADU of about 300 to 400 square foot based on the quality and the location, which generally means you can get about $1,500 a month or about $18,000 a year in rental income. So the Noah investment in this case, that $100,000 investment, enables you to generate approximately $18,000 a year in rental income. Also, because you did not go to a bank, because you did not take a personal loan or a credit card, you're actually saving $1,000 a month with us, which we call as Noah savings, right? So Noah savings are the payments you avoid by choosing Noah as compared to working with a traditional lender. So if you just look at the rental income and the savings, you are basically up $30,000 a year, de facto. And I hope, for all of us that over the next 10 years, as California is kind of an amazing place to stay, the value of your home also rises, right? So in the example I have, I've taken a very aggressive scenario where over the next 10 years, your $1 million home is worth $1.5 million. So now in 10 years, we've generated a ton of income, we've saved a ton of money, but now at the end of 10 years, what happens? At the end of 10 years, you have to pay out NOAA essentially, because that's the term of the financing. Please keep in mind, you can pay us back anytime before 10 years. We have a lot of customers who've taken money and paid us back in 18 months, in 25 months, in 35 months, because there is no prepayment penalty. But let's say for argument's sake, in this example, you stay with us till the end of 10 years. At the end of 10 years, if the value of the home goes down, so let's say your $1 million home, it goes down to $750,000. I promised you I'm going to share in the losses of the home value. So in that case, our $100,000 investment is worth $82,000 only. So we are going to take a principal loss of $17,500 on your home, which I can bet you no bank ever is going to do that. So we are sharing in the downside with you. Also, if the value of the home goes up, if the value of the home goes up to 1.5 million, which is a very aggressive but a rosy scenario for all of us, then the value of Noah's $100,000 investment is now $225,000. But the remaining 1.275 million is yours, right? So we enable the investment, and then we share in both the up and the down with you. And that is our partnership-based financing model. This is obviously an example here. It's highly possible that the value of the home is anywhere between 750 and 1.5. And in that case, the NOAA share will be proportionate essentially. So to give you an example, if the value of the home is 1.2 million, you are potentially paying us back 150, 160,000 in that case. If the value of the home goes down to like 500,000, so let's say 2008, 2009 happens again, home value drops massively, NOAA will be completely wiped out. We may only get $5,000 or $10,000 back in the scenario, and that is okay with us, because we think of this as an investment in you and investment in your home, and we are willing to take that risk. And the reason I can say that is because NOAA is also a non-recourse investment. So if we lose money, we only can get the money from the house. We cannot get any money from you. So we are not, unlike a lender that goes to your bank and goes to court and says, hey, Amy and Olysia, you owe me my money. And that doesn't happen with NOAA, because our investment is in the house. Our partnership is in the home ownership essentially with you as well. And yes.
Question.
Absolutely.
Talking 10% and then you're showing 13%. I know the answer, but I think you have to explain to other people. Okay.
Yeah, of course, right? So in this case, you can see that we've given you 10% of the value of the house, but the NOAA share is 13. So one, this is an example. The actual terms for every single one of you, every single homeowner who comes to our website is different. Some people may get 12.5 and some people may get 14.5, right? It's customizable. And the reason for that is there is a significant amount of risk, as you can imagine, NOAA is taking, right? We are giving you the capital, but we are not charging you any interest rate. And for 10 years, we're not even charging you any payment. So there is a significant amount of, say, housing risk and credit risk and market risk that NOAA is taking. And the delta between giving you 10% and taking 13% in this case is basically our risk premium of sorts. I would encourage you to think about it, that this is no different from that the Federal Reserve gives Bank of America the money at 0%, but Bank of America lends it to you at 5%, because there is a credit risk that you have that Bank of America is pricing that the Fed is not pricing for Bank of America. We are not a lender, so I'm using the analogy to show as to why there is a 2 to 3% difference between the money we give and the share we get. It is simply an allocation of risk from us and our investors.
And I guess also, how do you define the home value? There is an appraisal coming in?
Absolutely. And absolutely. So, I said, right, one of the things we want to do is we want to be utmost, honest and transparent through the entire process. So every transaction we do has a home appraisal up front. The home appraisal is done by AMCs, which is appraisal management companies. And those are companies that work with all sorts of, real estate investors, lenders, banks. These are independent companies as well. So NOAA has no business affiliation or relationship with the AMC. So an appraiser comes to your house, he takes pictures, he measures the house, he submits the report, we review the report, and that determines the final value of the house. One of the things I want to mention is in COVID, we've had a lot of homeowners who said, I don't want anybody coming into my house, right? And that's a very real, health hazard. So what we've done is we've built out a new system, which is called, Owner Insight, in partnership with another company, where we send you a link. With that link, you take pictures of your house, you submit those pictures to us. Those pictures are then sent to a licensed appraiser. He appraises the house based on the pictures and dimensions you've provided, and then the appraisal report is generated. But every single time we do an appraisal, also, if you disagree with the appraisal and say, okay, it came in at $1 million, but I really think my house is worth 1 million, you have the option of doing a second appraisal as well. So there is utmost flexibility built into the entire process, Olivia.
But that is on homeowner, right? So
Yeah.
as a homeowner, I decide which appraiser to invite. And then if I don't like him, I basically go shop for a different one.
Appraisal management company, right? So in order to streamline the process and scale the business, if you work with 1,000 companies, it's not scalable. So we have a pre-vetted list of appraisal managed companies who are licensed appraisers. So it's very, Amy can attest to it. It's the same process that a bank does. That they say, hey, I'm sending an appraiser. If you don't like the appraisal, we'll order another one. And that time you can say, I want to pick somebody else. But the individual has to be a licensed appraiser. It can't be my brother-in-law or my sister doing my appraisal. Right. That doesn't work. Mm-hmm. Yep.
Thanks.
Yeah.
Sahil, I have a question. Can I ask, please? Thank you for. Thank you. It was really interesting, and thank you for your presentation. So I'm more than sure that it's well explained in terms and conditions. But let's imagine the situation that I woke up in the morning, or me and my wife, we don't want to be partners with you anymore. It's not haven't been 10 years. Let's say we were partners for 3 years, and we still owe you the same amount of money. But today I want to cancel our deal. So what are the consequences here? Can you please ask?
There are no consequences, Matt. So firstly, I would be happy that you chose NOAA and you were a partner for 3 years. At the end of 3 years, you say, hey, Sahil, I think I'm selling my house or refinancing, or I just want to buy you out. At that point of time, we would do another appraisal of the house. The appraisal of the house will determine what the future value is. And that would determine how much
money
you would pay us out, essentially.
So there is it's going to be just mathematics, nothing else.
Yes, there is nothing else. At the end of the day, it's just money, right? And I believe money works best when it's in the background. So we have a standard equation or a formula that we said, I give you 100,000, I take 13%. In the future, as the value of the home changes, the value of the NOAA share evolves. And that is why we will also do an appraisal on the back end as well.
But excuse me, you've said the appraisal of the future value. So you're appraising like at the end of the 10-year term, or did
Yes, absolutely. Because we always need the value of the house, right? And we always want to make sure that the homeowner and investors are comfortable that the value is not determined by NOAA, but an independent third party. So we do an appraisal upfront that sets the terms. We also do an appraisal at the end of the term, or whenever, in this case, say 3 years when Marriott wants to buy us out, and that would dictate what the exit price of the transaction is as well.
Right, but it wouldn't be a 10-year projection. If he wants out at 3 years, it's an appraisal at that time, at that 3-year point.
Absolutely right.
Which
that's what I was digging in.
Yeah.
By the way, can you stop sharing so that everybody can see that? Yeah.
Okay, of course.
Because I can.
Yes, I apologize for the confusion. So it's basically, whenever you buy us out, it is the appraisal at that point of time. If it's 3 years, it's the appraisal at the 3-year term.
Good.
There's no such thing as an appraisal.
That was like, that's why I asked my question, because it sounded like an appraisal of future value. And I go,
well, that's
excuse me?
I mean, I think he wouldn't have a business because that's where trust would just leave the picture. So
yes, exactly.
Yeah. And what happens if at the end, I mean, I know that you're just 4 years old as a company, but what happens theoretically if at the end of 10 years, the homeowner is not ready to pay you guys back?
Absolutely, right. So that's a great question, right? And it's something which, we've obsessed over a lot. right? So the homeowner has about 4 different options, right? So option 1 is if you're selling the house, you sell the house and we get our share from the proceeds of the home sale essentially. Option 2 is a lot of homeowners, hopefully in 10 years, your LTV, FICO and other things are better. So you may refinance the house and the refinancing proceeds become a way to pay us out. Option 3 is, you may have a startup that goes public. You may get a bonus or you may get a job with more income. You have more savings. You can use your savings or cash to buy us out. Option 4 is something that we worked on with, some of our homeowners where at the end of the term, if you're unable to pay us the full amount, so let's say 100,000 today is worth $150,000 in 10 years. And for some reason you can't pay the full amount, you can pay us a portion of the amount and we can roll you into a new transaction of 10 years so that you have another 10 years to pay us out. So option 4 is obviously available to, homeowners assuming that everything else, and you've been a good partner to us in the previous 10 years. It's like every partnership has flexibility built in. Noah is the same way. You have these 4 options available to you based on your financial profile, based on your, home ownership journey. You can pick and choose, one of those 4 options.
Thank you.
Absolutely.
Thank you.
Okay, well, I cannot think of any other questions actually for once. Anyone else has any questions?
I actually see a couple of questions in the chat. So, so there is one question.
Okay, yeah, please.
So there's one question. Can you explain what the payoff looks at the 10-year mark? Is it the total amount owed, or do you just make, or do you start making payments at the 10-year mark? Okay, the entire amount. So yes, so it is almost like at the end of 10 years, whatever is the value of the Noah share, based on the value of the house, that amount is due. You don't start making payments at the 10-year mark. You pay the entire amount in one lump sum. So it's almost like a balloon payment of sorts, right? So that was one question.
It's not plus the 13.
No, it is
13 total. It's 10 that you originally borrowed plus the 3% bump that is Noah's basically their fee, which is very reasonable actually. For my mortgage banking years, sounds reasonable at least.
Yep. The other question somebody asked is, I understand that the share is the full amount plus 13%, or does it pay for the start? No, it's not. It is not 100,000 plus 13%. It's not that. It is that today we gave you 100,000 and we now get 13% of the value of the house. As the value of the home changes from $1 million to 1.2 or 1.3, you can imagine that the value of that 13% is also going to change, right? And that is what you owe us. It's not 100 plus 13. It is whatever the value of that 13% is in the future, and that's what Noah gets from you. And one of the things we do is, as you go through, our online website or through an application, we actually give you a chart as part of the final signing and the funding terms to say, this is it's essentially like a table where, this is the value of your house, this is how much you'll pay us. If this is the value, this is how much you pay us. So you basically have a table that shows you, 10 to 20 different scenarios. So if your home goes from, so I'll use this example still, just to make it clear. If the home goes from $1 million to $2 million, then the value of that 13% will increase, right? It's worth 100,000 today, but the house has doubled. So 13, our 100,000 may be worth about $250,000 at the end of 10 years. Yeah, so it won't be 300,000 as you are saying. And I'm more than happy to send an email specifically to talk about that example as well.
Okay.
I've never had an event when somebody didn't get a homework. So now Eddie has homework to check what the hell is there on the website.
No, I will definitely take a look at that. Absolutely. Thank you.
Yeah.
Like the next question is, what is the Noah territory where this is deferred? What is the Noah territory where this deferred loan applies? So this question is from Gina. So Gina, I believe you're asking territory means what region we are available in? Okay, yes. So we are available in 11 states right now, but within every state we are available in most of the neighborhoods, and that analysis happens at the zip code level. So the best way to do that would be to just go to the website and enter your address, and we can tell you whether we are available, in your neighborhood or not. And if for some reason we are not, you have the option of entering your name and email. And when we are expanding to that neighborhood, we will drop you a note and we'll work with you. The next question here is, like, how do you own that 13%? What type of document, what type of agreement it is? Okay, so that's a great question. So we don't own 13% of the house. We have a financial interest worth 13% in the house. And the documents we do is that in California and the West Coast states, which are, deeded states, as they call it, and the East Coast states are mortgage states in this country, we will file like a deed of trust, which is more or less the same document that you sign when you take a mortgage. And that deed of trust is notarized with a title company, which is then recorded with the local county office of your neighborhood. And that becomes public record. And that is how we secure the financial interest with the deed of trust document, essentially. And again, you have access to those financing docs before you get funded. So you obviously have an opportunity to review the docs and make sure you are comfortable with them as well. The next question from Arthur is, how is your agreement different from Unison or Point? Yes, that's a great question, Arthur. So
Great.
yes, so with regards to say Unison and Point, right? So with Unison, I'll tell you up front, all things being equal, I am 1000% sure that our financial terms will be significantly better, by 20–30% better than what Unison will ever offer you. The other thing is, I showed many of you earlier that you can get a quote in 60 seconds from our website. With Unison, it's going to take you 2 weeks to even understand what happens there. And the reality is, we believe we are a much more technology forward, a data-driven company building a transparent and trusted brand for homeowners. And our promise to you is a 10-year promise across the entire journey, right? So I think we are better on terms, we are better on service, and we are better on pricing than them. I think with regards to Point, I think one of the things you see is they normally will take your appraised home value and they'll apply 15–20% discount to the value up front. And then they have all of these different restrictions on you many times when it comes to financing. We don't do any of that, right? It's a very clean and a simple analysis. We give you 100,000, we take 13%, and that's it. There are no additional terms and analysis to be done, because I recognize, our entire team recognizes, you have a lot going on in life. You don't need a full mathematical Excel sheet to do one more transaction. We want to make it very simple and very easy for you at the end of the day.
Well, I have to say that there is nothing easy when it comes to single family properties. So one of the questions that will come up is when you work with older clients and they've got kids, and do you advise them to put the house in a trust before they start working with you, or like?
So I'll tell you the story, right? So our oldest client is an 80-year-old French lady in Palo Alto who bought her house in 1958 for $30,000 in Palo Alto. You can imagine what the value of the house today is. 60 years forward in Palo Alto, that house is worth millions of dollars. And she is amazing where, when we worked with her, she had an adult daughter who was not on title. And then we worked with her to make sure that, whatever happens to her in the future, the house is secured for her and her family at the end of the day. We actually wrote a blog post. If you go to noah.co/blog, we actually wrote a blog post about why it makes a ton of sense for every single homeowner, independent of age or family situation, to put the house in a trust. You don't want your house to be stuck in probate and all the legalities if something unforeseen was to happen to you. So absolutely, we are fully on board. We've also worked in unique situations where I think husband and wife are divorced or estranged, and the wife wants to buy out the husband. So Noah provides financing to the wife, allow her to buy out the husband completely and clean the title. And now she's the sole owner with the lien of Noah in there, right? So we have looked at that situation. We've also worked in situations where, the parents are older, so they are not that tech savvy. So we talk to them on the phone or otherwise, but the son or the daughter is helping the parents with the transaction. And in that case, we will obviously require a power of attorney or something else, because we have to secure the financial interest of the family and the older couple as well. But we take the power of attorney, we share it with the legal team, with the title team, we get approval, and we work with them. So we have done transactions with somebody who is as young as 33 years old and is a Facebook employee, and somebody who's 80 years old and is retired as well. We run the whole spectrum. We have worked with them offline, online, on the phone. and you name it, and we've done it actually. Our next question is, can you send this PowerPoint out? So so I will work with Olivia. I think the idea is to have the full recorded session out as well. We definitely will make it available, and that actually gives us an idea where we will take snapshots of it and write up a blog post, which is also easily consumable for everyone else. The next question, Arthur, from you is it a real estate option as it is the case with Unison or Point? If yes, how is it different? What makes it simpler?
That's what happens when you get former brokers, former real estate agents on the call. Yeah, go for it.
Is it a real estate option agreement?
Yep. So Arthur, yes, it is a real estate option agreement. Now, the reason the title of the document is the same across companies is because that is how the IRS and the HUD and Fannie and Freddie allow us to give you money without you being taxed on it, without us becoming the owner of the house, while you still retaining control essentially. So the financial transaction happens through an option agreement. So that's the first part. And now what makes it simple is, I think you'll have to do a transaction with us. So I would highly encourage you come to our website, and what we should do is we should record it. We should record you starting up application with Noah, Unison, and Point at the same day. And let's see who gets you the capital the fastest, easiest. And then I would love for you to write a review and say, this was my experience with 3 companies, and this is the one I choose.
Yeah.
You're a great speaker, Sahil. You're a great speaker, Sahil.
Thank you.
The reason you can do this is because of that agreement.
Like absolutely right? Because
it's the agreement that allows you to do what you're doing.
Yes, because we looked at other ways as well, right? So I have a background in financial services and in consumer finance, and I was like, how do I make it simple? And the simplest way would just be to have like a simple note between you and me, and I would have loved to do that. But the challenge is a simple note, it creates complication for you and me at the end of the road, where who is responsible for insurance? So what happens if the home has to be sold, amongst other things? And what was important in our option agreement that we've developed is we want to make sure homeowner stays in control. Homeowners have all the rights of home ownership, and Noah is, as I say, a passive minority partner where we will step in if you need us to, but it's really your show, it's your car, you are driving it, I'm in the backseat essentially. So our entire agreement is developed with that as a thesis. You are the driver, I'm just the passenger at the back who's all along for the ride.
And I think we have run out of our hour. We are always
okay.
one minute. And if anybody has like any burning questions, you're welcome to still kind of put them in the chat, and we'll try to cover them later on. Okay. But before we kind of sign off, can you say like, who is it that the homeowner, say I was to start the process on the website?
Yep.
Who do I end up working with? Is there a special kind of advisor? Or?
Yeah, so one of the things we do is we have an in-house team, right? So Arthur, that's another difference between us and say Unison, for example, who I believe has a call center somewhere in Phoenix or Arizona where your call ends up going. We actually have our internal team, who we call as home advisors. These are not salespeople. These are people who work for the company full time. And their job is a couple of things. One, their job is to educate you on the program if you have questions, very similar to the way I've done it today. Their job is to be your primary point of contact through the entire process from estimate to funding. You will only deal with one person all the way till funding, and then our funding department takes over. Your application will not be passed around between 5 departments and 6 people, when you work with Noah. So, Olivia, to answer your question, we have an in-house team. We call them home advisors. They all have a background at companies like SoFi, which is a personal loan mortgage company. They worked at Lending Club. They worked at, other startups and home equity, businesses as well. So these are people who truly understand the entire process. We have an in-house, education and training module where they go under training before they actually talk to clients. And then at the end of the day, we also have 2 other things. Like one, we have a highly detailed FAQ, which I think, Arthur's already looked at, because he's seen the website. So you can find all the answers, but we also have a widget where you can schedule a call with us at any point of time. Whether you started an application or no, it doesn't matter. You can schedule a 30-minute slot. You can talk to us. We can answer your questions, and then we can go from there as well. And we had one last question here, which is,
That's a question for me, and I have to look up the.
Like it is a, can you send the link for the EDU chat?
Yeah, doing it right now.
Okay.
And actually, it's amazing the way you describe what you are doing in financing is the way I describe what I'm trying to do in construction, because I don't want homeowners to go talk to somebody about ADU first and about the remodeling of the main house, then to the solar contractor to figure out what's the best combination. I want them to come to one point of contact so that we could get them from, we call it from concept to keys.
Yes.
In one place, and that's why we are trying to partner with similar companies.
Absolutely.
Thank you, so that we could get it all under one umbrella.
Well, everyone, thank you so much. And if you have any questions, I will ask Alicia to share our email and other things as well. And more than happy to be in touch and work with at least some of you on the ADU side. Thank you.
Well, thank you very much. It was a pleasure to have you here.
Everyone.